Morning, everybody. Welcome to our Leadership Summit. We've got some very interesting speakers today. I've actually been looking forward to hearing from a couple of the speakers, and I'm just going to kind of run through the agenda. And to start with, you're going to have the accountants speaking, and we're doing this first because we're thinking everybody's had a cup of coffee and you'll be able to stay awake for our section without too much difficulty, hopefully no. And actually, we're going to try to do our best to keep it interesting. But we have Elisa Howes, she's a partner at Malden & Jenkins, and then myself, I'm a partner. And we work mostly in our nonprofit practice and talk a lot about stimulus these days, and we're going to provide information to you about stimulus. And then after that, we have Karen Kemp and Jeff Jowdy, and hopefully you've heard them speak before. And they're going to talk to us about achieving fundraising success during a pandemic. And as we all know, that is extremely important to do. And they're going to have some good advice for us on that. And then we have Al Vivian, who should be a very interesting speaker. He's the president and CEO of Basic Diversity. And he's going to talk about creating diversity in competent leaders. And that's something that I think we're all going to benefit from. And then lastly, we have a philanthropist, I'm sorry, I can't pronounce that correctly, Marion Glover, and he's the president with Glover Capital. And he's going to give us a perspective in regard to that. So we're kind of starting off with the stimulus discussion because, as we know, it takes money to perform our mission, and then get more into fundraising, and then talk about diversity in our workplaces, and then talk about fundraising as it relates to somebody who's actually out there in the community and performing things for our communities, with these funds. So we're going to transition briefly and then start our conversation about stimulus funds. So we've prepared a number of screens it's really a lot of information, for the session. And we're going to move through a lot of these very quickly. And I think that if you can just kind of pay attention to things that might be applicable to you, and don't worry too much about the details. And I think that if you can just be aware of things and then know to ask questions if something's applicable to you, that's the key, of what we're trying to accomplish here. And we're going to inject some insights into things that we've learned and things that we've read and heard, and hopefully give you a little bit more insight than maybe what you've heard before. So once again, Elisa, Kyle, and myself will be the presenters for this part of our session. So the first thing that we wanted to talk about was the loan forgiveness process, and Elisa's going to start walking us through that.
Welcome everyone today. Thank you for being here with us. It's our pleasure. And today, like we said, we have a lot of slides with information, and some of that we may not be going through in detail today, but we wanted to leave that for you so that you have something to refer back to, and just sort of want to walk you through the loan forgiveness process and how this is started, and some specifics later on new requirements for nonprofit organizations and what loan forgiveness means to them, and specific applications that are now out there and applicable. We're just talking about, eligibility, the amounts, the rates and maturities and such here. Eligibility, a lot of you have already received your PPP programs and such, and probably been through the audit process. If you're going through an audit, and have talked about the disclosures related to that, the amounts and such. The key thing here to remember is the amount, 2.5 times a borrower's monthly payroll costs for employees, and then no more than the $100,000 per year to be prorated, or $10 million, whichever is smaller. Rates and maturity, a 1% interest rate. Payments of both principal and interest will be deferred for 6 months following the date of the loan disbursement. However, the interest will be accrued during that time period. Loans are forgivable provided certain criteria are met, and which we'll spend a lot of time today talking about that. and loans issued prior to June 5th have a maturity of 2 years, and loans issued after June 5th have a maturity of 5 years.
So just real quickly, we've got the PPP funds. A lot of you have probably received those monies. You had a period of 8 weeks or 24 weeks, depending on what you decided to do, or sometime in between those two, in order to make a decision about what your covered period is going to be. And now what you're doing is considering filing through your financial institutions for forgiveness, for those loans. And I had a question today on a finance committee call about, okay, what if we're not forgiven? And that's most of what we're going to be talking about here, forgiveness. And if you're not forgiven, that's this bottom section of the screen is talking about it is a loan. It has a 1% interest rate from the date that you receive the money. So it's not any other date. It's the date you receive the funds. And it either has a maturity date of 2 years for most people, and that's the case because most people receive their money prior to June 5th, or it has a maturity of 5 years. And if you receive funds after that, and your bank has an option to extend your loan to 5 years if it turns out that that's necessary and something that the bank agrees on.
Okay, and this next slide, under certain loan conditions, Jeff was just talking about the 8 or 24-week period. Existing employees are retained at near current salary levels. So that's, of course, the thing to remember. Employees cut the wages reductions will reduce forgiveness amounts. Employees are allowed to rehire employees previously let go before the application without the penalty. Proceeds from any advance up to $10,000 on the EIDL loan will be deducted from the loan forgiveness amount. And of course, the AICPA has a really good tool out there on applying for loan forgiveness. And later in this presentation, we're going to talk about specifically a form that applies to nonprofit organizations and walk you through that. That has recently been published, and there's very specific questions in that for nonprofit organizations.
So just a couple of key points here. You have a covered period of time when you had the time to spend this money, and it's either 8 weeks or 24 weeks. And that's, you check one of the two on your loan forgiveness application. And you can't choose a period in between 8 and 24 weeks. That's an early application period. But you still will say, if you get beyond the 8 weeks, that you're in that 24-week period of time. And when you are forgiven, hopefully you are, they'll reduce it by any amount of the EIDL loans that you would have received in the past. From the CARES Act. And then there's various tools out there to help you prepare these applications, and the AICPA is the primary tool that we've been using, but there's others out there also. And just be aware that in general, as long as you did not have a reduction in full-time equivalents, and as long as you did not cut your employees' pay by more than 25% in the covered period, then you hopefully will be forgiven. But there's another criteria that you're going to have to pay attention to, and it's this need criteria that we're going to discuss in a minute. And then, of course, besides the those considerations regarding full-time equivalents and cuts in pay, you have to, of course, spend the money. And you have to spend the money on payroll, at least 60% of the funds on payroll, and then the other 40% can be other covered costs that we're identifying here, including rent payments and then some other costs that are allowed to be covered costs. Most people are able to meet the expense criteria with just payroll and not having to use other covered costs.
And as Jeff mentioned, documentation verifying the number of full-time equivalent employees on payroll, pay rates, including the payroll tax filings reported to the IRS, state income tax, payroll, and unemployment insurance filings will all be reviewed. Documentation including canceled checks, payment receipts, transcripts of accounts, and other documentation verifying payments on covered payment areas such as mortgage obligations, utilities, and other areas. You must certify the documents provided are true, and the loan proceeds will be used to maintain employees on the payroll and make eligible rent, mortgage, interest, and utility payments. The lenders will determine if forgiveness is appropriate within 60 days.
So once again, covered cost includes primarily payroll has to be at least 60%, and then other covered costs include rent, mortgage interest, and utility payments.
Some of the facts on PPP loan forgiveness, there's a site up here from the SBA that has a lot of information, but SBA began accepting loan forgiveness applications on August the 10th. PPP loans will not be subject to single audit requirements, but EIDL, and then there's very specific, we spent a lot of time with different trainings throughout our firm talking about funds that went out to HHS, U.S. Department of Education. There's a lot of CARES Act funding through the Higher Education Stabilization Fund and such that are subject to single audit or uniform guidance requirements. There are even for-profit organizations now, primarily in the healthcare world, that have received this funding that now will be subject to the traditional uniform guidance rules and compliance requirements. Very specifically in the education department as well, colleges and universities that receive the Higher Education Stabilization Funds, that has been determined would be a major program for most of these institutions. And there's also, under current IRS guidance, PPP expenses are not deductible.
So if you have received more than $750,000 or more of CARES Act funds, not in the form of PPP money, but in these other forms that are passing through HHS, Department of Education, and other departments, in general, it's subject to the single audit requirements, which means you have to have an independent auditor audit the use of those funds. And then in regard to the current IRS guidance, if you're a for-profit, even though at the moment there's been guidance from the IRS that these PPP expenses are not deductible, so if that was to stand, in effect, the revenue that you have received would be taxable. There's a pretty good understanding at the moment from both Democrats and Republicans that they're wanting this to change, and most people are thinking that sometime maybe in mid to late January, we're going to see some more guidance on this to where the expenses are deductible. So in effect, the proceeds are not taxable for a for-profit. So we're waiting for that. And personally, I don't see it. It seems impractical where they would let this stand where the expenses are not deductible, because that would be a significant burden. And then in effect, what would be happening is the money that they've given companies to pay their employees to be able to survive what they're experiencing with this virus, they would have to give some of it back to the government in the form of tax. And to me, it's just contrary to the purpose, of the whole program. So this is a interesting topic. When's a good time to submit your application, and when, or should you wait? And the big consideration here is this need certification. So if you all recall, when you filled out your initial application to borrow these funds, you made a certification that the funds were necessary for you to support the ongoing operations of your business. And I would say that at the beginning of this pandemic, everybody felt that way, and most everybody applied for these funds because we had no idea what was going to happen, the effect it was going to have on our businesses and our nonprofits. And it was, for the most part, unless somebody felt like their funding was not subject to change, for the most part, people applied for these funds. So now there is a thought, and the SBA and lending institutions are going through this evaluation process of, was there a need truly in order for you to support the ongoing operations of your business? And it's more of an after fact kind of look at, was there a need? And if it's determined that there was not a need in accordance with what was signed in regard to the certification, it's possible that your loan will not be forgiven, and you will actually have to meet those payment terms of the 2 years or 5 years, with the 1% interest rate. The first 10 months of the payments are actually deferred. So this is just a big consideration, and there's a form that has just been released by the SBA, and it was in the Federal Register, and it's open for public inspection now, and it will be used once it's approved. And currently, they're cutting off the use of this form for loans that are $2 million or more. And if you look in the Federal Register, they identify the number of users they're expecting to use this form. And in my opinion, that is way more than the number of people that took out loans of $2 million or more. So I'm thinking it's possible that even though the initial cutoff is loans of $2 million or more, where they're going to be using this form in order to get more information on this need certification, it's possible they could drop the threshold and apply it not just to loans of $2 million or more. And they've been saying all along that these loans, even though they've drawn a line at $2 million, is in regard to an audit criteria. They're not saying that you wouldn't be subject to audit if you were under $2 million, just depending on the circumstances. So it's something to be aware of, that we've got this new form that's out there asking for information in order for SBA to assess whether you met this criteria of needing the funds for ongoing operations. And we're gonna talk about that in a little bit more detail in a minute.
And are you eligible to use the EASY PPP loan forgiveness application? And there's just some criteria here. One, are you self-employed and do not have employees? You did not reduce your employees' hours and did not reduce the salaries or wages to more than 25%. And 3, you experienced reductions in the overall business and health directives related to coronavirus or COVID-19, and did not reduce the salaries or wages of your employees more than 25%.
Basically, you want to make this determination early on, because it is much easier to fill out the EZ form than the full form. And if you had none of these things happen, then you're eligible to fill out the EZ form. And I would have to say that we're preparing more EZ forms than the full form. So hopefully you would qualify for that. And if you don't, the full form is not very difficult and still something that, it's practical to do. And then just get assistance from your professionals with any questions that you have.
The next area we wanted to talk about is just really based on available guidance and the way forgiveness application is designed. It appears that spending more than your loan amount during the covered period counteracts the negative effects of a reduction in FTEs or salaries. The due date of the application, the taxpayers will be basically generally have around 10 months from the last day of the covered period, the 24 weeks from the date of the loan disbursement, to file their loan for the forgiveness application.
Okay, let's just talk about this a little bit more, because this is kind of a big question. When should you apply for forgiveness? And most people are past the 24 weeks now. And when you're going through this debate, if you're having a debate, the first thing that you want to do is just accumulate data. So accumulate through your 8-week period of time or the 24-week period of time, whichever you're choosing, rent payments, mortgage interest, and then consider the fact that in regard to rent payments, that are related party rent payments or mortgage interest, you've got to consider the fact that rent paid to a related party is only eligible for forgiveness if the amount of forgiveness requested for the rent payments is not more than the amount of the mortgage interest owed on the property during the covered period of time. So there's a limitation there that you've got to consider if it's a related party, and you've got to pay attention to the fact that the lease and the mortgage had to be entered into prior to February the 15th of 2020. We talked a little bit about this, but it's important to be aware that you've got a submission that you will actually make with the bank. the lender has 60 days to review that submission and then send it to the SBA, and then SBA has 90 days to process your application. And I've talked to a number of lenders, and in general, from what I've heard, lenders are not going to be making the decisions on forgiveness, and it's really going to be more up to SBA. And I can see where there'd be exceptions to that, but in general, that's what I've been told. And another thing to keep in mind is SBA will make a decision within 90 days. And it might be very, government typically they'll get a little bit overwhelmed, and you might expect for it to be towards the end of the 90-day period of time. And but even after that, they have 6 years to audit. And we have seen some forgiveness document or some forgiveness correspondence from SBA just in the last couple of weeks. And in my opinion, even though they have an option to audit you within 6 years, I'm thinking that once they forgive your loan, remit those funds to the bank, because that's what they're doing, is they're paying the bank back instead of you paying the bank back. I'm thinking that unless something egregious comes up, like fraud that they've detected or something like that, you're probably okay. That's a matter of opinion. But it seems like it's going to be difficult for them to go back like 3 or 4 years later and come up with a different determination, in my opinion, even though they have that option and they have 6 years to perform an audit. The lenders have these 4 different possibilities. They can approve it in full, they can approve it in part, they can deny it, and they can deny it without prejudice. And that's where the lender, if you just read this, the lender uses the status when the SBA notifies the lender that a loan review is pending at the time the borrower submits the forgiveness application. So I think what you're gonna see is that the majority of these are going to be denied without prejudice, because they're going to submit them to the SBA in order to approve the need certification, and then also to make the final approval, in regard to the expenditures, that they're qualified expenditures. And this is going on behind the scenes, and I don't think you're going to see this part of it. I would assume if it was denied, you would see that, but from the clients we have so far that have gone through this process, they did not receive a notification that they're in any one of these statuses. And I'm assuming you can look up the status that you're in, but I haven't had any communication from clients where they got concerned about being put into one of these statuses.
And Jeff, we just have a real quick question on, we had talked about, based on available guidance, it appears spending more than your loan amount during the covered period counteracts the negative effects of a reduction in FTEs or salaries. Do you want to talk about that in a minute?
And that is correct. And if you look at the way that the forgiveness application works, you can have a reduction in FTEs or even a reduction in compensation. And if you've spent enough money in your covered period of time, which now can be all the way out to 24 weeks for most loan recipients, it counteracts that FTE reduction. And we've actually seen that several times now with clients. And when I first saw it, I sent a Q&A question to the AICPA because I was wondering about it, if the math for the form was not working correctly. And then I've asked other sources since then, and we actually have found a few articles from law firms addressing this topic. And from everything that we can tell, that is correct. And if you've spent more than your loan amount, that offsets any reduction in forgiveness that would have occurred because of a FTE reduction. So this screen here is talking about the 3510. So for nonprofits, this is the new form that is going to be used. And currently we're expecting this to be used for loans of $2 million or more. And if you're in what I'm recommending to my clients is that if you have a loan of any significance, and that's subjective, what's significant, but in my opinion, if you're in that 1 million or plus more neighborhood, I'm recommending that they take this form and complete it, and just so that they kind of know where they stand in regard to how the SBA could possibly be looking at your forgiveness application. And keep in mind, we're sure that they're going to be using this for 2 million or more, but at the moment they're not using it for less than 2 million. But I still think there's some risk depending on when your loan is processed, that if you're under 2 million, they might eventually be using some of the same criteria to evaluate your loan. Hopefully that's not the case, but it's possible. So you should be aware of risk of it not being forgiven by just looking at this form and considering the things that they're looking at. And if you study this form, there's a couple of things they're looking at. They're looking at your liquidity in the quarter prior to when you receive the funds, and they're looking at your revenue trends in your covered period of time, and then they're looking at your liquidity or net assets at the end of your covered period. So, and there's a lot of other questions on the form in addition to trying to get at that. But you can tell they're definitely using liquidity type provisions and operating results in the form of revenue. And then for the nonprofit form, they're actually looking at expenditures too, because they're wanting to see that, yes, you did have a decline in operations in your covered period of time. And then they're looking to see, well, did you have any existing sources of liquidity, cash and investments where you could have offset negative operating results and not use these PPP funds, I think is the bottom line of what they're trying to get at. And it's open for interpretation on exactly how they're going to take this form and apply it. And I'm sure over time, we're going to get more information on that. But as of now, we don't really know exactly how they're going to apply it. We talked about this before, but HHS funds, there are significant requirements here. And in summary, these are funds that healthcare providers have received. And a lot of nonprofit healthcare providers have received these funds. And it's subject to single audit, once again, if it's $750,000 or more. The primary way that they're looking at this, and there was a notice that came out in late October that gave us a lot more information about how you're going to be able to retain these funds or whether you'll have to pay them back. But they're taking 2019 revenue and comparing that to 2020 revenue. And if you had a decline in revenue, then the amount of that decline is a portion of these funds that you will get to retain. And then in addition to that, you can add to that any virus-related expenditures that were not paid for by other sources like PPP funds. So as of now, we're asking our clients to take January through June of 19 revenue, January through June of 20 revenue, look at what the decline is. So if you've had a decline in revenue for those comparable periods of $100,000, then if you've received $100,000 of HHS funds, theoretically that amount will be forgiven. And then they're adding to that any coronavirus expenses that they're tracking separately. And this is going to be a 2020 calculation. So we're doing it as of now for our June 30 year ends, but you'll have to do that for the full year. So it's something to keep track of. And if you have not spent the funds by December 31st, there's a provision where they're going to give you until June 30th of 2021 to spend the money. And then hopefully that's occurred, and then you won't have to pay any of the HHS money back. And there's been multiple rounds of stimulus that is coming from HHS, being distributed through HHS. And I would expect that to continue because the healthcare industry has been affected so dramatically, by the virus.
Next, we just wanted to talk about the employer and employee relief provisions, liquidity and tax effectiveness, efficiencies. In summary, of the COVID-19 provisions affecting compensation, benefits, and payroll, there are retention and leave payroll credits, employee retention credits, there's an emergency sick leave, of course there's FMLA, deferrals, distributions, coverages, and loans. There's permissible plan distribution and payment, Group Health Plan, expanded permissible expenses, defined benefit contribution extensions, and unemployment benefits. So we have a few slides on some of the information, some of the payroll tax deferral information. Applicable employee taxes for the payroll tax deferral period are not before the applicable date. So we have some detailed slides that just talk about this payroll tax deferral. Payroll tax deferral period, the periods beginning on the date of enactment of the CARES Act, so March 27th, 2020, and ending January 1, 2021. And there's, you can see there applicable dates listed for some of these other payroll deferral programs not available at the SBA loan forgiveness under 1106 and 1102 CARES Act.
So just one comment in regard to the payroll tax deferral. There was some discussion, and President Trump made comments that if he was reelected, he was actually going to forgive, the deferral, and then you might have read that he actually didn't have the ability to do that, and Congress had to. There had to be an action through Congress in order to forgive the payroll tax deferral. And there was significant concern that if you did this and deferred the payroll taxes for the employees, that they wouldn't have the means to repay it, in this repayment period of time. And a lot of employers decided not to defer, the payroll taxes for that reason, for the employer deferral. And then for the employer deferral, there was a number of people who decided not to do it either because they didn't want this future obligation, in order to repay these amounts. But, it's kind of, if it's something that you can take advantage of, if you have the discipline to set the money aside, and then it's kind of free money, for the period of time that you're making the deferral, and then just pay attention to these due dates where you've got to pay it back, on December 31st, 2021 and 2022 for the employer deferral.
Okay, then we have employer retention credits. Eligible employees receive 50% credit for qualified wages up to $10,000, $5,000 maximum credit per employee. Wages paid to employees after March 12, 2020 and before January 1, 2021 includes healthcare expenses. Credit against Social Security taxes precludes double benefits under work opportunity tax and leave credits. There's also excess refunded or applied against other taxes. Some information, the eligible employer operations suspended full or partial result in a government order, over 50% reduction in quarterly receipts measured year over year, and looking at each organization for certain tax exempt sections. Governmental employees not eligible for this credit. And then you can see here on the slide, we're talking about with 100 or fewer employees or more than 100 employees.
So once again, just keep in mind here, there's an employer retention credit, but to be eligible, your operations had to be suspended as a result of government action or over a 50% reduction in quarterly receipts. I can't say that we've had many clients that were eligible for this, but it's just something to be aware of.
There are some additional CARES Act compensation and benefit provisions. There's a student loan assistance. Employers may contribute up to $5,250 tax-free towards the student loans of employees under non-discriminatory arrangement. There's plan distributions, required minimum distributions for defined contribution plan and IRAs suspended for 2020. Plan withdrawals and repayments for certain taxpayers personally impacted by COVID-19. Plan withdrawals up to $100,000 permitted without the early withdrawal penalty. Plan loan limit, qualified plan loan limit for 180 days from enactment to increase to $100,000. And then funding, required funding of qualified plans extended through December 31, 2020. And this all relates to the compensation and benefit provisions.
there's paid leave provisions, and just keep in mind, if you have an employee who gets sick with the virus, there's provisions where you can be reimbursed for up to 80 hours of compensation, based on these limits that are on this paid leave provision screen. And there's also provisions that exist through the FMLA Paid Leave Act where you can be reimbursed. So just keep in mind, if you've got that situation, it's something you need to pay attention to, because you can save some money there in regard to being reimbursed, while the employee's out. I'm assuming that, you're paying the employee while they're out. And then this screen talks about the triggers in that regard. And then what Elisa was just covering, just as something to remember, that, they're trying to give people a break on not having penalties by taking monies out of a pension plan or 401k plan. And there's other assistance that they're applying here, through December 31st of 2020. And this is a big deal, I think, because there's a new above the line charitable deduction up to $300 for individuals who don't itemize deductions. And if, as you all might be aware, if you itemize, you can claim charitable contributions, but if you don't itemize, then you get a standard deduction. And in effect, charitable contributions don't affect your income tax return. So this provides a means for people who take the standard deduction and then also want to get an above the line deduction up to $300 for charitable contributions. And then there's another change in regard to corporations where they're permitted a deduction of up to 25% taxable income for charitable contributions, where it used to be up from 10%. So just a couple of incentives that were put in place to encourage corporations and individuals to make contributions to charities. And this is something that, it's good to point out to donors so that they're aware of this additional deduction. So once again, we know that's a lot of information, and we're trying to give you a little bit of insight into when you should apply for forgiveness, and then just make everybody aware of the fact that you've got these payroll provisions in regard to employer and employee deferrals in regard to payroll taxes that you need to pay attention to, make decisions on. And then you have other provisions in regard to Family Leave Act, and if you have employees who get sick, where there's some credits that you can take directly off your payroll taxes for that. And one thing that you did not see in these slides that I wanted to point out, there's a significant amount of funding that's available through your local governments and available to nonprofits. And if you have not done this already, just be aware of monies that are available that indirectly have come through county government and city governments to help provide support, for various nonprofits. And I'm very active in the Cobb Chamber. And one thing that was interesting to me is there's a good bit of money that the Cobb Chamber was managing that flowed through Cobb County government, and nonprofits were able to take advantage of these funds and this assistance. And there was money that was not even really ultimately used because there just weren't enough nonprofits that applied or utilized the funds. And I think a lot of nonprofits applied and took advantage of it, and which was good, but there was more money available than what was applied for. And that's just one example. I've been paying attention to other counties that have significant funds available to spend, and just be aware of all the different sources of money that's out there that you can benefit from in order to keep performing your mission and getting through, this virus until, the vaccine becomes effective. So hopefully you gained some insights, and we're going to transition now into Karen and Jeff talking about achieving fundraising success during a pandemic.
And Jeff, I think we have a couple of questions before we transition.
Okay.
We had one question, does the employee use, basically, for these available benefits, does the employee use their sick leave first, or are they able to use the FFRC funds, other available funding methods when they have to take time off because of COVID?
Okay, so the question is, should the employees use sick leave? So if somebody is out with a COVID-related illness, a diagnosed COVID illness, the employer will actually be reimbursed, through these provisions for up to 80 hours. And I would say that the employee in that circumstance would not be using their sick leave, because in effect, the employer is being reimbursed, for the time that the person is out.
Okay, thank you. And the last question we have really just relates to the time period that it's taking for forgiveness. Question is specifically like, will it take up to 150 days to obtain forgiveness? Do you have any insight on the time period that it's been taking?
So you might have been reading about this, but 3 or 4 weeks ago, there was actually, news articles that SBA had not forgiven anybody. And I think the department was under pressure, and now we're starting to see some applications that have been forgiven. And depending on volume and resources that they have to devote to this, I would just anticipate, if it was me, banks needing at least 30 days, and they have 60 days. So just depends on the bank, but I would anticipate the 60 days for the bank, and then I would anticipate the 90 days for SBA, and just hope that it's sometime sooner. But for planning purposes, I would not count on anything different. And another thing I wanted to throw out there, Truist sent out an email to their borrowers a couple of weeks ago. And Truist, as you all know, is a combination now of BB&T and SunTrust. And they were actually recommending that applications should not be turned in yet for forgiveness, because they were saying in their email that the rules are most likely changing in regard to forgiveness, and might be more stringent at the moment than they will be in the future. And because of that, they were recommending that applicants possibly defer their forgiveness application until those things are settled, which was kind of interesting. So a lot of things to consider in regard to when you turn in your application. But in my opinion, if you're under the 2 million, you look at that form that we looked at, and you don't really have any concerns in regard to revenue trends or expense trends, or using the money for COVID-related expenses, I think it's not a bad thing to get it in there, and then just get the process moving.
Well, thank you. We really appreciate everyone being here today. I think we're going to take just a quick transition and start back up at 10 o'clock was just in a few moments. The next topic, creating diversity of competent leaders, with Karen and Jeff will be speaking. So myself and Jeff Facito's information is on the slide. So please feel free to reach out to us with any further questions, and we're happy to answer those. Thank you.
So while we're transitioning, we're going to answer a few of these questions that are sitting in the Q&A. And actually, it's easier for me to talk through these versus type in some of the answers I was just getting ready to type in. So loan forgiveness, there's a question about how's the loan reported at the end of the year if you haven't received your forgiveness yet? Is it reported as a loan or revenue? So there's actually some accounting guidance that has come out to help you address this. But for nonprofits, you have a little bit more flexibility. You can treat it as a grant, which would mean that you're recognizing it as revenue, or you could treat it as a liability, which is the legal form if you have not received forgiveness, because it's technically a loan. And if you feel like there is not much uncertainty surrounding the balance that you've received, we have some clients that have made a decision that they want to report it as grant revenue so that it matches up better with their expenses that they've incurred, where they've taken the money and spent it. But if you feel like there is any uncertainty in regard to forgiveness, then generally you want to leave it as a loan. And that's the conservative thing to do. And then recognize it as revenue after it's been forgiven. Now, for for-profits, you don't have as much flexibility that I just described. And in general, for a for-profit, you're going to leave it as a loan until it's been forgiven. Once again, look up the accounting guidance that goes into some pretty good detail about various considerations on how you're going to treat it either as a loan or as revenue. And there's some really good AICPA guidance out there now. Next question, if you do not receive forgiveness when you have to file your year-end tax return, do you take the deduction on the return for qualifying costs? So that's a good question. And that's one of the things that is kind of messed up about all of this. Because technically, at the moment, if you just read the current IRS guidance, they're saying you don't qualify to deduct expenses for amounts that are forgiven. But if you haven't been forgiven yet, it's kind of like the chicken before the egg kind of question. And what I'm thinking is going to practically happen is I think we're going to have an answer on this before you have to file your return. And most of what we're hearing is that we're going to have an answer on this in January. And I'm not hearing a lot of doubt about this sticking where it's not deductible. And we just don't know until you just don't know with Congress. But the hopes are that this changes, and the expenses are deductible. So in effect, the income does not end up being taxed. So I would just recommend just hold on and see what happens. And I think this is going to be dealt with pretty quickly because they're not going to want a bunch of taxpayers to file and then have to go back and amend returns and take expenses off their return because they filed and deducted the expenses already. And I think technically that is what people would have to do. You would deduct it and then you would amend later if you were forgiven. But, hopefully all of that is avoided. Next question, if a loan is less than one, is there any risk of liquidity certification being challenged by SBA? Not sure what was presented, clarity. So there's risk in any circumstance, in my opinion, and probably more risk the larger your loan is. And you just have to consider that. But I don't think there's as much risk at the moment if you're under 2 million, if you've had liquidity and other items that might hurt an application if it was more than 2 million. So there's always a risk. And like I said, just complete the form and get an idea of how much risk you have, and then just go through the process, and then you can just hope for the best. And I think there's at the moment very little risk if it's under 2 million, in my opinion, but those thresholds could change. And I think that's all the questions that we've had so far.
Thank you all so much for taking this time this morning. I'm delighted to be able to introduce our speaker today, Al Vivian. Just to share, I know you've had a chance to review his biography, but I want to share a couple of things with you. Al is the son of civil rights icon and pastor, the Reverend C.T. Vivian, who passed away not long ago. He served honorably in the Army as a captain. He's now the principal of Basic Diversity. But what I want to share with you about Al is that he's an extraordinary leader who knows how to energize others. He gets people excited about the possibilities and helps individuals and companies create an atmosphere where people want to be a part of the change that we all need. Al, we're delighted to have you this morning and look forward to your comments before we have some questions for you. Welcome, Al.
All right, thank you. Good to be here. So I'm going to switch over and try to get my screen up. All right, so what I want to talk about is the fact that we need to learn to connect across our cultural differences. So since there's been an introduction of me, I'm going to skip through most of this. All right, so these are some of the organizations we've had the blessed opportunity to work with over the past 46 years as a company, 29 years for me. I want to talk about the 7 traits or the 7 tips for becoming an inclusive leader. What I want us to understand off the bat is that we were not prepared to lead today's workforce. And here's why. So all the leadership theories that were created starting about 70 years ago back in the 50s, they had three major flaws in those leadership theories. One, they focused only on the traits of the leader. They paid no attention to the follower. Two, they only studied white males in Western civilizations. Nothing wrong with white males in the Western civilization, but if you want to understand a field and study a field like leadership, you cannot do that by excluding 3/4 of the world's population and think you're going to understand leadership. Third major flaw is it paid no attention to diversity and culture and the impact they have on human beings and their interactions in organizations and societies. So I want to talk through some tips on how we get past that to do things right. So tip number one, become inclusive or become irrelevant. Here's what I mean by that. Our demographics are changing massively. And as fast as our demographics are changing, if you cannot connect across all those cultural differences and create an environment where everybody feels included, because that's what inclusion is about, an inclusive society and an inclusive environment is an environment where every type of person feels included. If you can't do that, you're not going to do well. Tip number two, your ability to lead will suffer greatly if you cannot connect across cultures. Kind of builds on what I just said a moment ago. So again, our demographics are shifting. You got to create an environment where all types of people can lead there, can learn there. And by the way, notice I said lead. I am a former Army captain, so I don't talk about management. We talk about leadership at Basic Diversity, not diversity management, inclusive leadership. I'll tell you a little bit more about that as I go through this. In my mind, in our minds at Basic Diversity, and what I had drilled in my head as a U.S. Army captain is that you manage property, you lead people. You manage property, you lead people. In other words, in our minds, management is policies and procedures. Leadership is inspiration, motivation, and vision. They're totally different things. So you got to lead across cultures. So the reason we messed this up is because a lot of us, there's stuff we don't know, especially as it relates to dealing with people from other cultural backgrounds. So we got to go from that unconscious incompetence, the stuff we don't know, to unconscious competence, where we can lead easily and connect across cultures. So I'm going to talk you through a process of how you get there. And I'm going to use a golf analogy to describe this. And if you don't golf, I apologize. Actually, I don't golf. I own clubs. I don't yet call what I do at my clubs golf. But let's say you're sitting at home, you're watching golf on TV, and it looks really simple, and you say, there's a sport for me. No running, no heavy lifting. I can ride around in a cart all day. I can dress well while I'm out there. And on top of all of that, I can consume my beverage of choice while I'm doing it. You said, that's my sport. So you don't go out and practice first. You just go out and you buy the clubs, you buy the bag, you buy the balls, because you figure it's easy. You see it on TV. So you go out there and you take the ball, you take the tee, you tee it up. Whack, you hit the ball. You know you connected because you heard the club and the ball connect. And you're looking in the sky for the ball, because every time you see it on TV, that's the way it is. It's the white cloud, the blue horizons, the white ball. So you're looking for the ball and you don't see it. And then you look down and the ball's about 3 to 5 feet in front of you. And you realize, oh crap, I can't golf. Here's what happened. You were operating in a state of unconscious incompetence. You were incompetent at golf, but you didn't even know you were incompetent at golf. You thought you could actually do it. The moment you hit the ball and the ball only went 3 feet in front of you, you shifted into conscious incompetence. You are now aware that you have a deficiency. And the next thing that hits your mind is the significance of that deficiency. Because now you say, uh-oh, I can't quit. I'm invested. I bought the clubs. I bought the bag. I own this stuff. So you say, well, can't quit because I'm invested. So I guess I better start practicing. So you might start practicing. You might even pay extra money and start taking lessons. And after a while, you can actually perform the task. But you have to think about it the entire time you're doing it. So now you say, okay, you take the tee, you take the ball, you tee it up. You say, okay, hook my index finger and my thumb, line my pinkies up, line my pinkies, line my thumbs up. Okay, eye on the ball, elbow straight, eye on the ball, whack. You can actually perform the task. But you have to think about it the entire time you're doing it. That's called conscious competence. You can now perform the task, but you have to think about it while you're doing it. After a while, you keep doing it, you keep doing it, you keep doing it, you keep doing it. Now you don't have to think about it. Now you walk up, you say, okay, the hole is that far out. I think I need this club right here. Whack, and you can put the ball out there without a lot of thought. You've shifted into unconscious competence. You can actually perform the task without putting much thought to it. Now that's a 4-stage process. I talk processes and competencies, because I want you to understand where you're going. A lot of times we don't try things new because we're afraid, because we don't know what the outcome is going to be. If you understand the process, you're more likely to try. We can get to the same point on cross-cultural interactions. We just have to walk through that process of going from unconscious incompetence to conscious competence. So what I want you to do is I want you to play along with me for a minute. I want you to picture in your mind the best boss you've ever had your entire lifetime. I literally want you to close your eyes and I want you to picture that boss. I want you to think about what were the behaviors, what were the traits, what was it about her or him that made them the absolute best boss you've ever had your entire lifetime? Take a few seconds, picture that boss. What were the traits? What were the behaviors? What was it about them that made them the one? Okay, open your eyes. Now, if I had you in person in front of me, I'd ask you, tell me what the things were that you thought of. Now, if you're like the average audience I do this with, the things you thought about were things like they listened to you, they cared for you, they motivated you, they had your best interests at heart, they introduced you to the right people, they invested in you. What none of you said is, oh man, what a policy writer. None of you said, oh wow, what a scheduler. In other words, none of you talked about management, policies and procedures. You talked about leadership. You thought about leadership, inspiration, motivation, and vision. They're totally different things. So here's what the point I'm making on that is this. Tip number 3, focus on leadership, not management. Focus on leadership, not management. Why? People don't want to be managed. People want to be led. People want to be motivated. People want to be inspired. People want to be connected with. Policies and procedures, management, will never get you a fully effective, inclusive environment. Management policies and procedures might get you a little more diversity in the door, because you might have a policy that says we must recruit from a wider, group of people. We must, cast a wider net. We must have a few people of color or a few women or a few LGBTQ community, et cetera. We must have a few on our list when we go out for interviews, but that still might get you a little more diversity in the door, but it'll never create that environment where that diversity stays there, thrives, and feels included. That takes a leadership approach. Now, difference between management and leadership. Here's some of the differences. And there are a lot of differences between the two. I really like the ones in red. That's why I put them in red. Managers follow the plan. Leaders follow a vision. Most important, managers focus on the systems. Leaders focus on their people. You focus on your people, you don't have to worry about anymore the stuff about the systems, because the people will follow the policies and procedures, they'll follow the rules because you showed them you cared about them, and they're going to follow you and do what you want them to do because they value you, because you value them. So tip number 4, compliance leads to complaining. Compliance leads to complaining. Here's what I mean by that. So the vast majority of diversity and inclusion strategies and policies within organizations are based on compliance, which is management. So it's pretty much acquiescence or adherence to a set of rules and policies. Leadership is different. It equals commitment. It's devotion to work towards a vision that includes and engages everybody. Compliance leads to complaining. People say, oh my God, now we got these new rules, these new policies that we got to put in place so that those people feel comfortable. Oh, I'm so tired of this. Compliance leads to complaining, but leadership leads to commitment. They're totally different things. So why do you stress commitment instead of compliance? Because the only diversity, equity, and inclusion strategy that will work for you is the one that your people are committed to. Tip number 5, people do not commit to policies, they commit to a vision. People do not commit to policies, they commit to a vision. Let me explain that a little bit more this way. So again, management equals compliance. It's based again on acquiescence to a set of policies, procedures, and rules. So the philosophy is we'll establish a strong set of policies and we'll put them in place and people will follow those rules. So that's what people think. Establish the rules, enforce those rules, we obtain diversity and inclusion, or diversity, equity, and inclusion success. The shortfall is, again, people don't want to be managed. They want to be led. And by the way, again, results you'll get from that: compliance, tepid response, and complaining. And I would even add, on a compliance standpoint, even if you put in an excellent set of rules and you implement them perfectly and the people all actually follow them, the best you will ever achieve is compliance. Best you'll get is compliance. But leadership process is very different. It's based on a logical and an emotional attachment. The philosophy there is emotional and logical attachment lead to commitment. So it's establish a vision, not just a set of rules. You establish a vision. You get emotional attachment to that vision. That commitment, that then leads to the commitment to the vision. That leads to diversity, equity, and inclusion success. So there's the result: ultra success. Why? Once you achieve commitment, you no longer have to worry about compliance. The people will do the right thing because you create an environment that says you value them, that you care about them, that you're all in for them. People feel as if they belong there. Now they're going to give you everything that they have. Tip number 6, mainstream no longer exists. Mainstream no longer exists. Demographics are shifting. So here's what I mean: mainstream no longer exists. The number of languages spoken in the US has increased. LGBTQ community is tired of having to hide who they are in order to be successful in society. 2011, more children of color were born in America than whites were born in America. First time that ever happened. 2012, more whites died in the US than were born. First time that ever happened. And if you know anything about generational diversity, Generation X, they do not want to be micromanaged. I'm a baby boomer. Boomers, you can micromanage us all you want. All you have to do is pay us well. We'll do anything you want us to. That's not how Generation X or Y or Z operates. Very differently. Other demographic realities. Globally, so I'm talking globally on this one. Only 17% of people entering the workforce new, globally, only 17% of them will be white males. That means the other 83% will be women, African Americans, Latinos, Asians, people of color. That's huge demographic shift. In the US workforce right now, people of color, those who are not white, people of color make up a third of the US workforce population. Add to that percentage, that 1/3 is supposed to double between 2010 and 2020. So at the end of this year, when they go back and they do the recount of all the numbers, we'll see if that projection equaled out the way they said. Chances are it did. Half the US workforce are women already. And globally, by 2025, only 5 years from now, by 2025, 75% of the global workforce will be Generation Y. That's the millennials. And I know a lot of boomers say, oh, I can't stand those millennials. We need to embrace the millennials. They are our future. The Generation Y, Generation Z, that's our future. And they're smarter than us. I don't have time to go into all of that because I only have a half an hour and I already wasted some of that time with my technical challenges that I had. So let me talk about the business case for all of this stuff. So I'm not going to have you answer the questions. I'll just give you the answer. So why do people start businesses? Okay, people start a business to make money. I have an undergraduate degree in business. People start a business to make money. Every once in a while, somebody will say, oh, I started my business to be my own boss. I always say, shut up. You can start a nonprofit and be your own boss. You start a business to make money. So the next question is, what do those businesses have to do to make that money? People often say, oh, they got to, create a product or service. No, you don't just create a product or service. You got to actually sell that product or service. You have to get some customers. You got to get a piece of market share. So here's the next question. Every company out there is trying to get a piece of market share. Every company out there has a product or service to sell. What's going to make people buy their product or service from one company versus getting that same product or service from another company? Quite often people say price. Price is important. Proven again and again, not the most important. Most important is quality. Quality, yes, it trumps. So I grew up, well, we weren't poor, but we were middle class, but barely. The civil rights movement did not pay well. Okay, let me just say it that way. So the civil rights movement activists, they had a lot of notoriety, but they didn't have a lot of money. In fact, when Martin Luther King Jr. won the Nobel Peace Prize, he took half the money he made from the Nobel Peace Prize and put it into his organization, the SCLC, Southern Christian Leadership Conference, to keep the organization operating. So you need quality. You need quality. quality products, quality service. So everybody's trying to get I said all that story to say the quality piece. I grew up on the layaway. So I'd buy the cheapest thing I could find that looked the way I wanted it to look, and eventually as stuff starts tearing up, you realize spend the extra money, get the quality product that lasts longer, saves you money over the long haul. Quality. Sorry about all of that long story. So quality. Here's the next question. What do you need to create quality products and quality services? What do you need? Some people say you need people. No, you need quality people. You can't load the place up with Sam Sausage Head and think that's going to work out. You need quality people. Here's the kicker. Quality people can go work anywhere they want to. What's going to make those quality people come work for you versus going to work for your competitors? It's an inclusive and valuing environment. You create that environment where people feel they're included, that they're valued, that they belong there, a sense of belonging, that their demographic grouping, their race, their gender, their age, their sexual orientation, or whatever it is, that's not going to stop them from being effective within that organization. You create that environment, then you attract and you retain the best and the brightest. Now, I could spend an hour on this box alone, but I'm not, but I do want to make some key points. If you don't create that value and environment, you don't get the quality people. You don't get quality people, you don't get quality product or service. You don't get quality product or service, you don't get market share, you don't get market share, you ain't making no money. You're not in business, you're gone. So that's one point I want to make on that inclusive environment. Second key point on that, you create that environment, you attract and you retain the best and the brightest. It used to be when an organization lost an employee, people would say, oh, well, we lost that employee. No, you didn't just lose that employee. You lost a lot more than just that employee. You lost the time and the money you spent to recruit that employee, the money you spent to train that employee, the money you're going to spend to recruit some replacements, to train some replacements. You might even lose some other employees because they may quit and go work for your competitor. And when they get over there with your competitor, they may call back to where they used to work, to your location, and the call is going to go like this. Girl, it is so much better over here. They're going to say, is it really? Oh, yes, it is. I don't have to put up with this. I don't have to put up with that. I don't have to put up with this. And on the other end of the phone, they're going to do this. Y'all got any openings? Can you get me an interview? And then you're going to lose some other employees and the time and money you spent to recruit them and the time and money you spent to hire them, et cetera, et cetera, et cetera, costing you a lot of money. Now, I want to add another piece to that. A lot of organizations, a number of organizations have finally caught on to that. And they say, okay, our goal is to attract and retain the best and the brightest. And they stop there. That too is not the ultimate end result. The ultimate end result is not to attract and retain the best and the brightest. The ultimate end result is to get the best from your brightest. And most organizations aren't doing that because in most organizations, they're forcing their best and the brightest who do not fit the norm mindset of what they're used to in the organization. They're forcing them to fit in and be like everybody else there. They're forcing them to be somebody that they're not. And when people feel they're forced to be somebody they're not, they're less likely to take chances. They're less likely to do risky things. They're less likely to do things that will make the organization money. They won't think outside the box. They won't be creative. So all of that creativity and innovation that comes with diversity gets stifled and stopped. And by the way, all studies done in this area show that the more diversity you have, the more creativity and innovation you have. By the way, the organizations with the highest percentage of diversity tend to make more money. In fact, I'm going to add on that on gender in particular. The Fortune 500 companies that have the highest percentage of return on investment are also the same Fortune 500 companies that have the highest percentage of women in senior leadership and on their boards. Diversity, equity, and inclusion make you money. But if you create an environment where people are forced to be somebody other than who they are, you're not going to get all of that. So tip number 7, you got to get the best from your brightest. You got to get the best from your brightest. And that's what most organizations are not doing. So you got to create that environment. You got to make sure you're leveraging all of that difference that you have in your organization, tapping into it and getting people to be who they really are. And that leads to ultimate success. So that's 7 tips. So on the recap of those 7 tips, tip 1, become inclusive or become irrelevant. Tip 2, your ability to lead will suffer greatly if you cannot connect across cultures. Tip 3, focus on leadership, not management. Tip 4, compliance leads to complaining. Tip 5, people do not commit to policies, they commit to a vision. By the way, every organization thinks we have this vision that includes everybody. No, the question is, everybody's got a vision, but does that vision include everybody? And in most cases, the answer to that question is no, it doesn't. In most organizations, when the senior leaders are sitting at the table to create a vision for the organization, usually people that look like me are not sitting at that table. Usually there are not a lot of women at that table. Usually there are not a lot of people in the LGBTQ community, at least not openly. So they don't get to be a part of creating that vision, so they get excluded. Not because people are trying to keep them out of part of the vision, but because the people sitting at the table are not even thinking from the perspective of those who are not like them. They're going based on what they're comfortable with, what they're used to, what feels good to them. And so then people get left out. The vision doesn't include everybody. Tip 6, mainstream no longer exists. Tip 7, you got to get the best from your brightest. All right, so recap, your ability to lead will suffer greatly if you cannot connect across cultures. So connect or die. I'm done. I'm open for some Q&A if you have some for me.
Thank you so very much for that wonderful, energetic presentation. I know everyone in our audience today would agree that we need to have you back. That's at least a half a day that we'd love to spend with you at some point. So thank you so much for that. We do have a couple of questions for you.
Excellent.
How do our listeners find and engage in culturally relevant professional development? Where can they go when they need to learn more about this very important subject?
So I would say, you can read books that will help. I would say you can do those things. You can watch documentaries and videos. But I think the absolute best thing to do is find yourself some cultural informants. So let me explain what cultural informants are. Cultural informants are people who do not look like you, don't think like you, don't act like you, people who belong to cultural groups other than your own, and start having dialogue. But now there's some rules to a cultural informant relationship. So rule number 1, let it be somebody you already have a relationship with. So let's say you are walking down the hallway at work and you see a Latino guy that you don't know. Don't say, "Hey, Latino guy, will you be my cultural informant?" No, don't do that. You need to let it be somebody you already have a relationship with, and you can use me as the fall guy. You can say, "Hey, you know what? I saw this presentation, and the facilitator recommended that we periodically have conversations with people that are different from us and ask their opinions on things. Would it be okay if I ask your opinion on various things on a recurring basis?" If they say yes, you got a cultural informant. If they say no, move on to somebody else. I would also say you need to get more than one cultural informant in each group, because if you may pick one, if that one is very atypical, not the norm, then you might not get the best information in the world. And point number 3 on that, when you get your cultural informants and you have the dialogue, when they give you their opinion and they tell you what they think and feel, don't push back. Just be quiet, shut up, and listen. It's not about agreeing with each other. It's about understanding each other. And if we debate with each other, they're never going to tell you again what they're thinking and feeling. So get some cultural informants.
Thank you, Al. Al, it seems these days that many of us are driven by the fear of making mistakes. Not only are we hearing that from some of our participants, but I think we've all experienced that. And at the same time, we're all driven in part by the need to be liked by everyone. How do you overcome that fear and do the right thing?
So one, the cultural informant piece helps a lot, because you'll find out a lot of the mistakes by talking to somebody that trusts you and you trust them, so that you don't make the bigger mistakes with just anybody you don't know. 2, when you make a mistake, because we all do it. I've done it, so when you make the mistakes, what we tend to do as individuals is we start trying to defend it. "Oh, I'm so sorry. I didn't mean it that way. My God, you're just too sensitive." Don't do that. Here's how you handle it. When you make the mistake, just say, "Oops, I'm sorry. My bad. I didn't mean it that way. I'm sorry it came across that way." Stop right there. Leave it alone. Let it go right there. You may go back to that person later on, especially if you all have a good relationship, and then say, "Listen, like I said, I made a mistake. I didn't mean it that way. Can we have a conversation about that?" But usually you make the mistake, just acknowledge that came out wrong. I didn't mean it that way, so please forgive me. Because if you start trying to explain your way out, you're going to be digging a deeper hole. Usually just say, "I'm sorry, please forgive me."
Thank you for that, Al. I think we've all been there.
Yeah, I know I have.
Al, our final question this morning, and then I know we have other questions coming in from the chat, and we'll talk about later and be able to get some information out to you. But many of our participants today are CEOs, and some are at earlier stages in their careers. What suggestions do you have for those who want to make an impact in their organization but have less control.
So if you're not a CEO, you have less control and you want to make an impact in your organization. Is that the question?
Right.
So a lot of times you can be the one that brings stuff to people's attention. You can ask the questions, and the easiest question to ask is why. So if you're noticing there that there are not a lot of women in senior leadership, you can just say, what? Why don't we have a lot of women in senior leadership in this organization? It seems like we have more. Or why is it that we always tend to do? So just ask the why question and just shut up and listen. Because a lot of times that makes people start thinking, because people are genuinely good. I mean, I really believe that. There are very few bad people out there, but there are a whole lot of really good people and a lot of bad information. That's why I started off with that piece about there's stuff we don't know. So we have a lot of bad information about those who are different from us because we've always looked at the world from our group perspectives. And if you're in a dominant group, and when I say dominant, notice I don't use the term majority minority, I use the term dominant, non-dominant, because you can be in minority, but still be the dominant group. Example on gender. Women outnumber men in America. Men still get to call the shots because we live in a very sexist, patriarchal society, just fact. South Africa, during apartheid, Black South Africans outnumbered white South Africans 10-1. So it's not about being the majority. They were not the dominant group. So I don't even talk majority minority. I talk dominant, non-dominant. And by the way, I am in a lot of dominant groups in America. I have loads of privilege in America. Now, people are not accustomed to hearing a Black guy talking about diversity saying he has a lot of privilege. I do. There are 13 recognized social categories in America. I'm in the dominant group in 11 of the 13. I'm male, I'm straight, I'm college educated, I'm Christian, I'm able-bodied. I am in the dominant group in a lot of those. What I want you to really understand about those is all but one of those I mentioned are unearned privileges. I didn't earn being male, I just happened to be born male. I didn't earn being a US citizen, I just happened to be born in America. I didn't earn, a lot of those things. So my faith drives me. And so for me, there's a scripture that says, to whom much is given, much is required. So in those areas where I was given this privilege, that's unearned privilege. That means there's a requirement that goes with that. In other words, I can't stand around and hear people make anti-immigrant comments and not challenge them because I have unearned privilege in that area. As a man, I can't stand around and hear people make sexist comments and not call them out on that because I have unearned privilege. That was a privilege given to me. To whom much is given, much is required. Now I hear people talk about their faith is important, but I hear them make some of the most racist, sexist, discriminatory comments. If you're going to say you value something, then value that. And in America, if we believe in freedom, justice, equality for all people, we have to ensure that.
Oh, thank you so much. What a great note to end this presentation on. And we are just so grateful for you. And I know that I will take these messages to heart, as I'm sure everyone will who's listening today. We thank you so much, and we look forward to having you back soon.
I look forward to it, brother. Thank you for having me. You all be blessed.
Now it's time for us to turn to our next segment, fundraising success in the pandemic. A common misconception in any economic downturn is that fundraising is going to completely dry up. But past recessions have taught us that the impact is actually a little more complicated than that. Past economic downturn data shows that nonprofits that continue fundraising during difficult times and widespread financial hardships tend to come out stronger than those who do not continue fundraising. Looking back at how organizations have previously adapted to survive hard times, we're going to pinpoint some key tips and strategies today for you to use. Let's discuss what we are seeing to help you emerge as strong as possible as we move through this pandemic. During the Great Recession in 2008, when the market dropped 40%, there were still some bright spots. Overall giving declined only 7% that year, and 6.2% the next year. And what we experienced is clients who met and exceeded their goals. So the challenge today and the opportunity is not to be average. That's what will make you stand out. Bill Stanishevitz, the assistant dean at Indiana University and Purdue University's Indianapolis's Lilly Family School of Philanthropy, noted that trends in charitable giving during a recession tend to take on a V shape with steep declines followed by steep recoveries over a period of several years. And during this Great Recession, charitable giving declined by just 5%. In the years following, from 2014 to 2018, something really extraordinary happened. We had seen the most generous level of charitable giving in U.S. history. In March, before the shutdown, we were identifying seven-figure gifts in a number of studies we were engaged in. And we have campaigns right now that are in various positions. One client that we worked with for a number of years to prepare and cultivate will end their campaign on time and will most likely exceed the goal and exceed it fairly substantially. Others, we have paused solicitation and recruitment, but we're continuing cultivation and other preparation. So there's much you could still be doing, even if you've had to hit pause for some reason. We have friends at a fundraising consultancy group in North Carolina who conducted campaign planning sessions this summer, and they were identifying significant gifts. And other campaigns, we're seeing green lights to move ahead with campaigns that were being planned. Our clients and campaigns are finding that significant gifts are the ones where they're having some of the most success. There was one client that transferred stock at an all-time high in order to pay for a seven-figure pledge. So growth in giving from donor advised funds, planned giving, online giving, platforms, and giving days, there are numerous opportunities that you can be engaging right now with donors and prospective donors. Now, one area where you're probably going to have to think outside the box a little bit would be workplace giving. Have to do some innovation there because everyone's working from home. And some organizations are receiving a bump in donations during COVID. So, for example, we're seeing with food banks, with social services agencies, those who deliver directly help during COVID, we've seen a fairly appreciable significance in their uptick in giving. We set up our conversation to say that 2019 was a great year for fundraising. It was $449 billion in giving, the second highest year ever, adjusted for inflation. That's according to Giving USA. Now, the RDK Group, along with the Nonprofit Alliance, commissioned a donor sentiment survey, and we think that their results were very interesting. And this is to suggest what December giving will look like. Based on the responses, it's clear that COVID-19 pandemic has increased the gulf between large gifts and small gifts. So the results show that larger donors truly have more to give right now. Now, this is the one that I think is the most exciting. 80% of donors say they plan to give the same as or more than last year. Only 20% reported that they would have to reduce their giving this year. 77% of donors have already given the same as or more than in 2019. And those who have increased their giving still feel they have more to give. So in order to truly understand the drivers of behavior, it comes down to the personal impact of COVID. We would strongly encourage you to, get personal with your donors, know what's going on with them. 65% of donors who plan to give more in December had their personal health impacted somewhat or a lot by COVID. So that says that that's a big motivator. 74% of donors who plan to give more in December had their families or friends' health impacted somewhat or a lot by COVID. 88% of donors who plan to give less in December had their personal financial situation impacted somewhat or a lot by COVID. And 71% of donors who plan to give less in December had their employment status impacted somewhat or a lot by COVID. So this just goes to show it's important to know, has someone's health been affected? Has their financial system been affected? And react accordingly. The personal impact of COVID is going to make a big difference this year. The larger donor they are, the more likely they're going to be able to give more. The higher education level they have, the more they're likely to give. And some very interesting things we've learned about younger donors. They're willing to give more. According to a recent Better Business Bureau survey, of 30.8% of donors plan to give more to charities this year. For Gen Z and millennials, that number is even higher than that. Now, this is a great time for us to transition to Jeff, and he's going to share some tips that we think will be very useful to you as you think about your plans for year end and beginning of 2021.
Great. Thank you, Karen. And just another observation is that I think as of yesterday, we talked about the Great Recession and the market being down 40%. This is someone said that every recession is different. That it's hard to compare, and your data is as good. But this is certainly not a standard recession, because I believe as of yesterday, the S&P and the Dow were about where they were at the beginning of the year. And it's hard to believe, because that's been a bumpy ride, and we've shared some of this a few months back, and it was down, and so it was back. So that just speaks to knowing your donors and knowing, again, who is impacted. So our tips for moving ahead, the first is really to be positive. And I think we all are familiar with the icon with the British crown and the stay calm and carry on. And that's certainly some good advice. First and foremost, we want you to take care of yourself, your family and colleagues, to focus on what you can control, to minimize distractions. If we listen to the narrative, some of the narrative on social media or cable news, I think we'd all be in a severe state of depression. And not that they're not real concerns to be addressed in our country and worldwide, but focus on what you can control, minimize distractions. Remember and send the message to your organization that fundraising is an area that makes money. And we know in higher education and other organizations, there have been cuts in fundraising staff. But these are positions that if they're not producing, several times the investment, then they shouldn't have been there to begin with. And if they are having that return, then it's not a very long-range approach to cut those. So you're engaged in noble work that makes money and transformational work. And as Karen shared, don't retract. If you're in a campaign, keep moving. If you're about to launch a campaign, keep taking steps and listen. Continue with your annual fundraising as scheduled, certainly not in the same way that you would have otherwise, and certainly continue with meetings. Now, our next point is on events. And if there was a silver lining in the pandemic, and I hope there are a lot of lessons to be learned, but one is stop having so many events. Too many organizations are reliant on events that are high in cost, high in staff time, and low in net and yield. And so if that sounds familiar to you, then take advantage of this recession, these economic times, the pandemic, and wean yourself. Have one signature fundraising event that does have a high net, a great yield. Think about cultivation events and think how you do things differently. But don't try and keep doing the same things over and over that have been low yield and just don't work. This is your opportunity to make the change. Do it now. Of course, if you do an event, then leverage technology. And as we've seen today, we have challenges from time to time, but it's a great new field, and the things you can do with technology is amazing and will be with us forever. It's a whole new day, and the pandemic has accelerated that. So you can do a lot of things with your events, but again, get rid of them, most of them if you can. Next is keep asking, and Karen mentioned that. Don't make assumptions. You don't know how someone is impacted, but you need to learn and ask, and don't be shy. Donors will really step up if given the opportunity, and they want to make a positive difference. And we discussed, again, that this recession, unlike some others, has not been across the board, that many people, most people of high net worth have, if they're in the market and they're pretty whole. Most people who have significant investments understand the long-term approach. The market will be up and down, and and real estate might be up or down. So they're leading it for the long term. What we found is that there are a lot of incredible people out there, frankly, who are bored. When we talk with some of our best friends and advisors to our firm and donors, they're bored. They're being cautious. They may be social distancing a bit differently. I would joke and say they may be at their farm or their beach home or their third or fourth home, but they are social distancing. They're being careful that it's a whole different environment, but they are bored and they want to make a difference, and they're ready to do so. Karen mentioned some of the things that have had incredible growth, with donor advised funds where there's no limit to what can be given. Even as a foundation, the same thing. You may have a typical payout at foundations. Many foundations have accelerated that to deal with some of the dire needs during the pandemic, and they're certainly very real. But giving is, of course, as much a values choice as it is financial choice. And again, just know where your donors are. And one of the big opportunities is to really look at donor retention, personalized messaging, recognizing the impact of their contributions. We all know that donor retention in this country is poor, and this is the time to really address it. It's also a time to keep in mind direct appeals and integrated approach using email, mail, video, and also to help your volunteers when you've had fundraising volunteers in the past. And again, it may be that many of them were focused on events, but be sure that you give your fundraising volunteers methods and support to be successful, coaching, whether it be crowdfunding or whatever it might be successful. Next is very important, some wisdom from an incredible donor and volunteer. Say thank you more than please. And this really speaks to the stewardship and how important and essential that it is. And just what a great time when people are feeling isolated, they may be bored, concerned about their health. It's a great time to reach out and connect with people. It's an excuse, a positive excuse to reach out. If you haven't been connected in some time, to pick up the phone and say, how are you doing? I was thinking about you, your family, and your colleagues. So don't be afraid to reach out and take advantage of that. Next is communicate. And this is not a time to withdraw in communication. So we would suggest to communicate more often, not less, but also to be precise, to really hone your message. We'll talk more about that because there's never been a time when there's more clutter and everybody seems to have a platform. There's marketing research that stresses that you have to repeat a message 7 times before it's absorbed. So sometimes you may think, oh, we just said that. Well, even if you talk with your own board members and say, what are we doing in these areas? I guarantee you a lot of times there'll be a blank stare because they don't absorb. They're dealing with business, their life, their family. Repetition is important. It's key. People want to know what's happening in your organization. And if there's a vacuum, then people begin to either think of other organizations or begin to imagine, what might be happening. So tell supporters how the pandemic is impacting you and be really sincere and honest about what you are doing to make a difference with those that you serve. Have a regular communication schedule throughout the pandemic. And then you're going to have some good news and a lot of good news, a lot of bright spots. So share those because people want to be uplifted, as we shared in the beginning. This is really a great time to update your case for support, to be sure that it's relevant, that you're relevant. Again, that your audience and care about them. We know the importance of sharing stories and not statistics. It's said that numbers numb and stories activate. So make your case in the form of stories that really are compelling and get the donor excited and put the donor at the center of your story in terms of making incredible things happen. An important thing too is with this messaging, check your ego at the door because it's not about how amazing your organization is. It's about what the donors can make happen. So we're all proud of our accomplishments, but be sure your messaging is donor focused. Other thing about communication is segmentation. With technology today and the ability to segment, everything you should have in terms of communications and even visits should be as tailored to the donor as possible. Obviously, this is a great time to be leveraging social media and engaging your team and upping your digital game. We found great magic with videos. And when you've seen our favorite talk show hosts doing their shows from home, there's a whole new expectation. And so homemade video on your cell phone from the CEO or from staff members is authentic, and it makes a difference. In 2013, Google conducted a survey, and they said almost 60% of people who viewed a nonprofit video would go on to make a donation. Now, we didn't do that kind of research, but anecdotally, we've got a wonderful client who the CEO we began to coach her on producing CEO videos, and she did one, and within 2 days, 3 people who had been $1,000 donors literally sent in $10,000 gifts, $30,000, and there were more gifts that followed. And it was not a request; it was an update from the CEO. So videos are powerful. Next is just to lean into relationships. You know, individuals still account for about 80% of all the gifts, and there's still individuals that are making those corporate decisions as well, and foundations. And so it's just an important time to, again, reach out to people and lean in to those relationships. If you have had staff cuts, then leverage board and volunteers and stewardship and engage them. Be sure that you're meeting with your top donors and reaching out on a monthly basis. Again, be authentic, be frequent, share your concern, and learn about them. How can you help them? And again, as we stressed, are they impacted or not? Are they worried about their health? Have there been situations? Is there economic situations? But it's really important. There was another study that EAB, which is a think tank for higher education, conducted. They interviewed about 110 or surveyed about 110 advancement folks in higher education. And their predictions, frankly, were very much contrary to what the donor research had showed, which was much broader. And those college professionals were thinking that the fundraising would be down this year, down next year. And one of the things that echoed in those conversations was that it's very hard to make new relationships during a pandemic. And we agree, that's right. But especially in higher education and in most organizations who have poor donor retention, we need to be focusing on our current donors anyway. And not that you're going to put off forever donor retention, but again, this is the time to lean into your existing donors and shore them up. So don't worry about you can't acquire new donors. You can, but there is a challenge there. Just focus on your best friends now, and you'll be plenty busy this year. We also found that there's greater access to many donors, especially high net worth and executives. So, typically an executive is used to having his or her assistant outside of the office as a gatekeeper answering the phone. We found now that oftentimes that person is answering his or her own phone and answering his or her own emails. So we've actually found there's greater access to a lot of leaders. And when you're leaning into relationships, just always think about the key groups, your key constituents, and how you can benefit them because they want to be connected. So if you have founders, retired faculty, parents, whoever they might be, get them engaged in those smaller communities. Again, segment and target, and let them have some fun and share about your organization. Chances are you've got experts. Again, if you're an independent school or higher education, you got faculty who are incredibly motivating and inspiring on a lot of topics. You've got, sports folks who can talk to people. So really leverage the expertise within your institution and share that. Next is data, which is so important. How good is your data? I was sharing with Karen last week at one of my, I won't identify which, one of my alma maters. I got a direct appeal from their planned giving office. My name was on it, and it invited me to make a planned gift. So maybe my name was on it, and I felt really personal, except for the fact I have 2 documented planned gifts with this institution. So it was really off-putting that they wouldn't even know that, and they're sending me an appeal asking me to make one. So be sure that you have the right data, and that you use it in the right way in systems. So look at your database, your top tier of donors. What information do you have? What information do you need? And again, if you have especially fundraising staff who aren't traveling as much, hopefully they're still connecting through virtual platforms, but all that saving of travel time, get on the phone and talk with folks and learn about them. We found over the years that very few people, if you call someone and ask them for even their birthday or their someone in their firm's birthday, they're happy to provide that. Maybe not the year, but the month and the day. So keep that going. Another golden opportunity is to conduct research. So again, depending on your institution, we're doing this with a client in January. We have a date lined up to film video, of some of their founders. So getting great insight on these leaders and what made them successful. So again, depending on your institution, if you're a college or university or independent school or other organizations, then you have a great platform to conduct leadership interviews and success stories and profile these leaders, providing a great service to your community, but also learning more about them and having a great cultivation point. And of course, we know about leveraging data to predict giving. So do the analysis so that you are making the right appeals at the right time. And then next is the board. And we mentioned earlier, you need to communicate with your board more often. We saw some organizations that were for a while pausing board meetings or making it uncertain. No, keep your regular scheduled board meetings. You want to, of course, keep your board strategic and not operational. And if you meet too often, you run into the challenge of maybe getting into operations, but you need that communications constantly. Elevate the stature of your board. Be sure they're profiled. Do little graphics with your board members and put them on social media and have them share them so that people know who's serving on your board. Be sure you have news releases on the board. And we mentioned the importance of CEO videos. I don't know if you recall early in the pandemic when things were certainly uncertain and there was just a lot of noise. The Queen of England, I don't know if you remember the video that she produced that reminded me of those that she would have produced during a wartime. And it was just that comfort. And your CEO is the chief spokesperson for your organization. Your board chair communicates primarily with the board, but there are times it's going to be great to, the board chair typically, co-signs the annual report and other important communications with the CEO. So there are times when you can leverage that leadership and showcase your board chair in video and other platforms. And just also it's the time to lean into your board and really take we found great success in board recruitment, board communication, board orientation, and that whole process. So review that whole board cycle and be sure that you're functioning at a high level and lean into that and go ahead and expand your board during these challenging times. And we found that our clients have had great success with that. And then volunteers, you want to keep your volunteers engaged, and your organization may have a few coming back, but it's not like it was in January or February. And there are many organizations that rely heavily on volunteers. So just be thinking about alternative ways to keep them involved. It may not be serving food in the food line or counseling or coaching, or they may do that virtually. But just think of every way possible to keep your volunteers engaged. Why? Because you need those volunteers to provide great services. Why? Because people contribute about 2.5 times to as much to organizations whether they are involved. So engagement is key. So find ways to keep your volunteers engaged. And then finally, and we talked about this at the beginning, if you're in a major campaign, then stay the course. Unless there's some extraordinary reason. We know of one organization, and we were just remiss that when the pandemic began, they're not a client, independent school, the board told the head of school, return money, return the gifts that have been made to a campaign and stop it. And that was the worst possible advice. And when you look at what's happened with the economy, that was the worst possible advice. So stay the course, be consistent, unless there's a dramatic reason why not to be. If you've been planning for a campaign, then keep moving, keep taking those steps, keep listening, and you'll have success. And don't, stop a campaign. Momentum is key in life. It's key in sports. It's key in fundraising. And this pandemic will have its timeline, and hopefully, with the great news of the vaccine, that it'll be next year. So we know that there are positive days ahead, and don't make an arbitrary decision. Be sure that whatever you do is based on data and facts. So that's a quick rundown. We've got a few minutes. We had one question, at least I know, and that was from a good friend of ours, Mark, who was asking about how he would grow his nonprofit. He's got a small nonprofit, and it's how that he could grow it to where that important mission could eventually be a full-time job. So we would suggest two things. One is the board is so key. A board is vital to any nonprofit. And when you're a founder, you typically have friends and family serving on the board. Well, if you want to be serious, you're going to have to begin to give up some control and have leaders from outside that circle on the board and engaged. Also, to be sure that your programs continue to be high value and your mission is very important, and you are doing things with excellence that no one else can. So look at the board and who's involved and be willing to expand that, because if you want major funding and a funder looks and it's you and your family, they're not going to have much confidence in investing in your nonprofit.
We are so delighted this morning to have as our special guest philanthropist, Marion Glover. I'm going to have a little fun with Marion this morning, and everything I can say about Marion is good, except the fact that he graduated from Georgia Tech. He may not forgive me for this, but go Dogs, Marion. Marion, after he had a stint at Georgia Tech, he got his MBA from Harvard Business School. He had a 14-year career with Coca-Cola, where he was vice president of corporate strategic planning and other roles. After serving as president of two different companies, he founded Glover Capital in Atlanta. Marion is a leader in the Atlanta community who has served and continues to serve so many nonprofit organizations. And we are so grateful, Marion, to have you with us this morning. Good morning.
Thank you so much, Karen. I'm glad to be here.
We have a number of questions for you this morning, and we're going to start out by asking you, what values and principles have led you to success?
Well, I don't know that I've been successful, but over the years, I think several things as I reflect on this question. Fortunately, I've been given a lot of opportunity throughout the years, and I could list a long list. Conditions where those happen, from college to work and all. But, a lot of people are given opportunities they don't even know they're there. And I guess from the early days, I learned that if you had an opportunity, you try to take it and pursue it and do the best job you can. And that's not some sort of great attribute. That's just common sense to me. And so I started with good opportunities. Then I had good mentors. I enjoyed Al Vivian's speech a few minutes ago, because I think my mentors were leaders, not managers, to use his terminology. They were people who motivated, who had really good character. And by the way, some of them were at the Coca-Cola Company back in the very early days, the best leaders I had. Another was in the military. I worked with a major general while I was serving my military duty. And like Al, who became a captain, I was just a lieutenant. I never made it to captain. But the fact is, this general I had was one of the greatest leaders I've ever been under. And I think the last thing is, I think once I get involved in a project, I want to see it through. I don't care how tough it is. In fact, sometimes the tougher it is, the challenge is are great is you enjoy it the most when you achieve it. Today, what we do, we sell companies for families and others when they're getting out of business. And you would be amazed at all the interactions and challenges we sometimes have. And one of them I just finished, we worked on 6 years before we achieved it because we had diversity in the way people looked at things. But at the very end, I felt great because the fact is, whatever success I've had has been, I'm stubborn, I guess. I just don't give up.
Marion, that's such valuable insight, and I particularly like what you talked about mentors for so many of us, and I think particularly for a lot of women who don't traditionally have mentors, that's such an important thing to seek those mentors throughout your career. What inspired your philanthropic journey?
I think it really started when I was at the Coca-Cola Company. Back in the days I was there, and I think it continues today, we were encouraged to get involved in the community. I was involved in the American Cancer Society and headed actually the Atlanta City unit. But that was because Coca-Cola wanted us to get out there and serve the community. Covenant House, I've been on the board of Covenant House. How did I get on that? Well, someone from actually my days at Coke said, we need some help with Covenant House. We're just starting it in Atlanta. And I could go on and on and on about my journey, but I think it began because I was encouraged by the large corporations at the time, the Coca-Cola Company, to do it. Now it sort of feeds on itself. I'm not there. I haven't been there in a number of years. But when something comes up that I'm really motivated to help, it's a great, great service. Even though I work every day, there's plenty of time to do some of the things we can do for the community.
You know, Marion, when Jeff talked earlier, he talked about, giving experiences and used the Planned Giving example of an organization that didn't have the best record keeping. And what's been your best giving experience?
Well, I guess when I think about that, I hate to say this, Karen, but Georgia Tech. And it's because they do such a good job at helping kids that really do not have the means to go to college. We have a thing called the Promise Program that some of you may have heard. And it started with a kid, I think he was in Brunswick, and his family was sleeping in a car, and he was trying to go to high school at the time. That child somehow got to Georgia Tech. They didn't have any money. So we formed, at that time, the president of the college formed a fund called the Promise Program. That fund today is one of the largest ways that we have actually helped kids that were underprivileged. That kid, by the way, today is a lawyer. That's the only bad turn in life he made, I guess. But the fact is, the tech program and the way they do it is fantastic. The way they raise money, the way they involve people, the way they stay behind people for years and involve them. And that's key, involving the people, even if they don't give you a nickel, or if they are not really high on the list of potential givers, just getting them involved in what you're doing. And you'll find people all of a sudden will just say, hey, I really want to help there. So anyway, my biggest would be Tech and Georgia Tech, and I'd have to say they really do a fantastic job.
Marion, all kidding aside, I know some of those folks in development at Tech, and they do a wonderful job, and it certainly has made a difference to that institution. Can you share, since you've shared your best giving experience, can you perhaps share your worst giving experience?
We sponsored a professor for 5 years at an institution, and in that 5 years, I never met the professor. And I just thought that was sort of a poor way of involving us in the gift that we gave, which was a major gift to fund their thing. But I think people just drop the ball. They just don't. They don't. And this has happened in other things where we've made a gift. And I think whether you make a gift or you don't make a gift, you really are sensitive when you can you don't hear anything. I've been trying to give office furniture in another office we just moved from to a charity I've been on for years on their board. I can't get through the board. I cannot get through their answer. I've called the development person. They're not there now. COVID, it means a lot of people are operating, differently. But it makes you feel like, well, what's happening with this charity or this organization? So anyway, interaction is very, very, very important.
Marion, it certainly is. And now more than ever during the pandemic, it's so important for nonprofits to stay in touch with their donors and friends and never stop communicating. How do you and your wife and family make your philanthropic decisions?
Well, it's only my wife and myself. We don't have any children. I met my wife in kindergarten a number of years ago, and poor thing has never been able to escape me. We really don't go through a very complex thing. We will sit at the breakfast table, the dinner table. We generally don't find time during the work day to do it, and just sit down and talk about the interests of the group that's making a request. And then we meet with them, when they want to come by and meet, we meet together. So it's a collaborative thing.
That emphasizes an important point for those of us that work in development, and that's, have everybody at the table that needs to be and wants to be a part of that decision-making process. Can you share what your top 3 philanthropic interests are and why?
The 3 things that we really enjoy participating in, first is our church. We're a member of Peace Street Presbyterian Church, and have been there for, almost 50 years. And I've served on the finance committee. My wife's been clerk of the session. So we've been very involved in that. And we enjoy the church's activities, whatever they may be. And so that's probably where we start. The second would be the colleges and the institutions. My wife went to Agnes Scott, and we've been very much a supporter of that. The last thing, I guess, is the foundations that I've been privileged to serve on. I'm currently on one of my favorites today is, as you know, Karen, is Presbyterian Homes of Georgia. And my gosh, what they're doing is so fantastic, and how they got through the COVID without any really significant bad effects. And I'm on the Franklin Foundation, which we give to about 200 different charities during the year. Franklin's a little different than a lot of the major ones. We're not a huge fund, but we believe in 5,000 or 10,000 here or there is very important to some of these charities. In North Georgia, I get about 3 months from Rabun County a story about one of the charities we support up there, what they're doing and how they're doing. And, that 5 or 10,000 we send them is just as important as the 50,000, 100,000 we send the University of Georgia and others for, major things.
Marion, with everything you've said this morning, and particularly with that question, you've talked about your personal engagement there. And I think there's such a significant message in that for, again, those of us who work in development and want to see all these worthy nonprofits succeed. And that's that people give where they're involved and where they're engaged. There's an old adage, what is it? If you want money, ask for advice. If you want advice, ask for money. So having those relationships that are sincere and real are so important. And I know when you mentioned Presbyterian Homes, one of the wonderful things about that organization is their long-term engagement with people and the way they treat their board members. And it's just so important and a lesson that we need to hear over and over. Marion, how long do you usually stick with an organization that you're supporting?
Probably too long, Karen. Sometimes you get into these things and you don't think of an end. I mean, you just think you're a part of it. And by what I mean by too long is that if I'm not really participating or doing anything in the organization, probably I should go toward one that has more needs. And the way what I'm trying to say is, you can't spread yourself too thinly with too many. To me, it's better to take a break and move to some that really have a need. We got one called Moving in the Spirit, which is a program for young kids that we're trying to help and get them through life where they don't have real good financial support. We just built a facility over on Edgewood Avenue off the MARTA line. And I'll tell you, that's just a fantastic new experience, being a part of building that building. The day we completed the building, and it's a pretty major fundraising, the COVID shut everything down. I mean, it was really funny. So now we're struggling to get through COVID. We got a new building in which we were actually going to use the building to rent out to people and other charities. So you really sometimes stay too long, I think, with a group. And honestly, I think in the early years, you have the brightest ideas, not maybe the first year, but the second or third year, you really kind of figure out what they're doing. And then you need fresh ideas and new people to come in. I'm a believer in a sense on term limits with how long you should stay on. Now, that said, there's emeritus programs or things, the ways that you can honor somebody and say, don't go away from us. Come to the Covenant House annual event at the Roxy Theater in Buckhead. Do these things. But you don't have to go to every committee or board meeting, So that's how I feel. Sometimes it's too long. Other times we just need to take ourselves and move on.
What a great message. And, it's been our experience, Marion, that high-performing nonprofits create opportunities for board members to step into another role, and Emeritus is a great example. And sometimes board members, organizations tend to have board service that goes on and on, when what some board members would like would be a positive exit strategy, how they could stay engaged in some way, but not have the responsibilities of day to day. Marion, something you said about longevity with an organization made me think. Over the years, I've had donors say from time to time, I prefer to change it up every year and give to different organizations. Do you find that you have more impact if you do stick with an organization for a while?
I don't know that I can always determine how long and what impact that has. It is hard to move away when you're making commitments every year to an organization. It's like not sending a gift to somebody at Christmas time you've been sending a gift to for 20 years. They wonder, well, what happened? Why did you stop? I like to sort of define the major gifts. So, you have maybe a 3-year pledge or 5-year pledge, whatever it is. And at the end of that period of time, then you sort of rethink or re-up or don't re-up for a while, take a break. At Georgia Tech, I moved off of one that I had a great interest in the way it started, but now I'm moving to a different one at Georgia Tech because they're funded, they're going. You do have sort of a different way of sometimes moving out of things, but probably you stay too long in the sense that you feel a guilt feeling if you don't do something for the organization.
Right. Marion, when we know that folks like you who have been generous and served so selflessly, so many different organizations, probably get approached by a lot of different groups. When you're thinking of serving on a nonprofit board, what do you consider before you say yes?
It's a good question. I tend to get pulled in because of a friend who I probably pulled in something else. That's the worst person you have is somebody that you ask them to help you on a favor because you're going to get asked to give money or be a part of their board. So I do start with personal feelings of people, and they tell you, people you respect, why you could really be helpful on this thing. It would be very hard for me to go on any board that somebody just called me up out of the clear blue and I didn't have any any contact or anything and want to go on the board. It's generally much more endeared to people you like. And so I don't know if that's a good answer.
Something I think our listeners would all be very curious about. If you were to become a full-time volunteer, what is it that you would love to do?
Oh, Lord, I feel like at times I'm a full-on volunteer on a very diverse group of things. I spend a lot of my time, I work every day. In fact, I'm so behind right now because we moved our office. I can't find some boxes of things that I need to work on. I don't think I'll ever become a full-time volunteer. I really don't. Part of it is I like having a number of different things I can get involved in. And I really think that sometimes your contributions you can make, you don't need to be full-time to do it. You really don't. And sometimes you need to back off because maybe what you think they should be doing is just your own thought and not the best thing. So, I don't ever think I'll ever be a full-time volunteer in anything.
I'm right there with you with that one. There's nothing like, I think, living your best life is often about being able to have a mix of the professional life that you love and are good at, and at the same time, be able to support those organizations that are important to you.
One
Is there
thing,
anything you would perhaps say to some of our younger listeners this morning? As I said earlier, when we were talking to Al, we have a number of folks that are CEOs and at probably the high point in their careers. And then we have some younger people who are perhaps just starting out or at the midpoint of their careers. Would there be anything you would say to them
yeah.
about?
Yeah, I will. When I was at Tech, we had a program called Executive Roundtable, and we would bring in the chairman of the Southern Bell or Georgia Power or whatever to speak. We'd have conferences at Callaway. And so for a younger person, I would say get close to those sort of people and get to know them. Generally, successful people that are leaders, like Al was saying, they like young people and they love having an influence. You were talking about women, and at Coke, back when I was there were very few women managers, but the ones that we got and we tried to help advance, they were so appreciative, and then we were so appreciative. They worked so doggone hard for what we had. You know, I heard somebody say one time in accounting firms, this was years ago, that if we probably went out and hired folks today, we'd hire almost all women. And you say, well, why is that? They say, well, they're conscientious, they work hard, they're sensitive. A lot of the men still think they're the fraternity at some college, that we won't talk about. And they're just sort of having a good time. And they were, bucket boys. They were this, they were that. And I think that hurts them. I really do. So I think the young people need to get to meet people that can be their mentors. And one other thing I want to say on fundraising, I've read a book on successful fundraising written by a professor at Harvard Business School. And one of the things he talked about is you don't always know what somebody really wants to give to or participate in. They had a gentleman who was, I can tell you his name was Rose Stamps. He and his wife, Penny, for 10 years never gave significant money to Harvard Business School. One day when they were on the campus, they went by the Baker Library and they looked at it and said, this library really is bad. It's just, they don't use it for anything. It's that way. And they got into it that way, and all of a sudden they gave a $10 million gift to Baker Library. We had a $50 million gift to Georgia Tech from somebody we didn't even know who they were, but they consciously saw the need through visits and all, and they followed up. And you just never know, who's going to be the real participant. So take a long-term view, try to get people involved. And if they really want to do something, it'll happen, not because just you ask, just because they get excited. Said more than I said.
And what great advice you shared. I'm going to ask Jeff to come up and join me at the podium. I know he'll want to say a word of greeting. And we just so appreciate your friendship, the wisdom that you shared, and for the Atlanta community and many other communities across the region. We're grateful for you and your service. Jeff?
Marion, it's great to see you, and thank you so much. And thanks to all of our participants for our annual Effective Nonprofit Leadership Summit, the virtual edition. We're looking forward to hopefully repeating this in the near future. We did miss a room full of our nonprofit leaders, but we're just thrilled with the conversations that we could have today. This is always a special event to us because, nonprofits are made up of different functions and leaders and CEO and the accountants, financial side, fundraising. So one of the great benefits of this tradition is that we bring leaders from all sides of a nonprofit together, and we all learn. We certainly learned a lot from Lisa and Jeff on the CARES Act and the important funding. Marion, your insight is always greatly appreciated and meaningful, and certainly Al and his discussion on diversity. So we're just grateful for all of our presenters. We're grateful to, again, our Lisa and Jeff and our friends at Malden Jenkins for this great partnership that we have. And it's our desire during this pandemic time to see you having great success in these challenging times, and that you and your family and colleagues stay safe. And we look forward to seeing you again, it looks like virtually, but in the not too distant future. Thank you again, everybody, for being a part of today. And this will be online. Elisa, do you want to?
Yeah, no, I just wanted to thank you on behalf of Malden and Jenkins and Lighthouse Council. They're great partners and leaders in the nonprofit world. So thank you so much for everyone's participation today. I think we had a great summit. And again, thank you to our great friends at Lighthouse Council for joining us today.
Great.
Thank you, and be well.
Thank you.
Thank you.